Hello, it's Drummond with a third quarter review for the CI Global Income and Growth Fund. While there are many factors influencing markets and economies over the third quarter, we think the most significant factor was the Delta wave-driven slowdown occurring or unfolding throughout the third quarter. The Q2, Q3 is likely to have been the peak for economic growth rates and for policy, both fiscal and monetary stimulus. It will also likely to be the peak for Delta cases and for some of the supply chain bottlenecks that have been driving up the inflationary pressures, as we expect both of these to moderate in the coming months. Interestingly, this reopening recovery is also reflected in the bond market, where the U.S. 10-year bond yield bottomed in August at about 1.15%, before now rallying north of 1.5% into September and October. This rally is consistent with our own expectation of a re-acceleration of the reopening recovery into year-end. While the reopening pause in Q3 was a definite headwind to the broad market position within the Global Income and Growth Fund, our fund did manage to continue to outperform during the quarter, with performance being delivered from strong stock selection, particularly in financials and technology areas. For the fourth quarter, we expect that the cyclical and reopening trend to resume and that the Delta wave will continue to subside and economic growth will reaccelerate into year-end. We expect that the reopening impulse from this declining COVID wave will be sufficient to offset the headwinds and the declining monetary stimulus that we expect during the quarter, as we expect the Fed to start tapering quantitative easing by the end of the year. And within Washington, the COVID relief packages have now pretty well been exhausted. And while there will be new fiscal stimulus from infrastructure spending and the budget, it will be significantly less than the COVID spending had been. But for the most part, we expect the theatrics coming out of Washington will be more noise than signal and should be mostly ignored. We do see that inflation, COVID, and a China slowdown remain key risk factors into 2022, but in general believe that the reopening trend will continue to favor risk assets into the new year. Thank you.